import goods overseas, the FTA is the first thing you should be thinking about. There's on the slide we'll see that is another category of another regime under which goods can make duty-free entry, and that's the so-called Generalized System of Preferences, or GSP. That allows for products that are manufactured in lesser developed countries if they meet the political issues that must be dealt with. In other words, they're friendly to the United States. Then if the goods are coming in from those countries and typically 5% of the cost is locally derived, then they will be entitled to duty-free entry. Examples of beneficiary developing countries would be, for example, India or the Philippines, typically. So if you're thinking about importing goods, then where you're importing the goods is going to impact the duty rate that applies. We've all seen two examples. Goods coming in from a free agreement country, let's say Australia, are entitled to duty-free entry. Goods coming in from a GSP eligible country, let's say the Philippines, the same goods, they'd also be coming in on a duty-free basis. Goods coming in from France, for example, you'd be paying the full duty because they're not eligible for any of the trade preferences. There is also an ability to make use in terms of duty elimination. You're allowed to bring your goods into the United States and put them into a foreign trade zone, customs bonded warehouse. And so long as the goods stay in those facilities, those are legal fictions that are outside the customs territory. So goods stored there and then never re-exported are exempt from duty because they enter the customs territory of the United States. A lot of companies look to stage their goods on a regional basis in the United States, and then they look to perhaps re-export them to other countries in the hemisphere, or they want to return them, or they want to send them on to some other market. If they make use of a foreign trade zone or customs bonded warehouse and they re-export the goods directly from those facilities, then they completely eliminate the payment of duty here in the United States. So that's something to consider rather than the alternative, which would be to import the goods, pay duty, and then perhaps seek a duty drawback refund after the re-exportation. We'll talk about drawbacks in a moment.
Mark, on the next slide, can you talk a little about some of the practical steps that need to be taken to either establish a foreign trade zone or customs bonded warehouse?
Good point. In regard to a foreign trade zone, it's a federal Department of Commerce process that prevails. You have to make an application to the Foreign Trade Zones Board, which is an agency or a subset of the U.S. Department of Commerce. It's a matter of public record, and you're able to file the application. And given the time frames, it's probably a 6-month to 12-month period. If you're looking to manufacture, and we'll talk about that in a moment as well, if you're looking to manufacture in a foreign trade zone, then you need to specifically request production authorization. If you're looking to and every customs port of entry is entitled a foreign trade zone, and individual companies can also get foreign trade zone status for their specific facilities. They don't need to pick up and relocate to be closer to the airport, for example. They can get, as long as they're within a 60-mile or 90-minute frame or proximity test to the boundary of the customs port of entry, they're able to get a foreign trade zone status for their own facility, and that's something to consider. A bonded warehouse is a little easier to get. You are only going to deal with the Customs and Border Protection folks. You're getting them to come out and to approve the cargo security of the that you've got designated as a customs bonded warehouse. One just between the two is that a customs bonded warehouse doesn't give you as many opportunities or options. For example, you're not allowed to manufacture. There's a 5-year sunset period for the goods in the customs bonded warehouse, and you're not able to take advantage of what's referred to as weekly entry. So, if it makes sense, a warehouse, could be the way to go. But if you wanted to take advantage of some of those other opportunities, then you should be looking into a foreign trade zone. Customs would need, after the application phase with the foreign trade zone, you need to go through customs to get the site activated. But that's a really straightforward exercise.
Yeah, one other comment on the foreign trade zones. This no longer applies to Ohio since we did away with our personal property tax several years ago. Those goods in a foreign trade zone are typically exempt for personal property tax. But it looks like from our list of participants today, the majority of the participants, I believe, have goods in Ohio. But to the extent you do have goods in a state outside of Ohio that imposes a property tax, there could be some benefit there as well.
That's right. Yeah. Ad valorem property tax exemption is a matter of right if the goods are imported or if they're domestically produced, but they're destined for export and they're staged in the FTZ on tax day. They're also exempt. So it can make sense. That state and local tax, local tax play is an important driver in states where there is that sort of a tax program in place.
We had one question come in, and that's whether the Philippines is still eligible for GSP.
I believe so. I would have to double check, but I believe so. Countries lose GSP typically because they become too successful. 4 Asian tigers all lost their GSP status back in the 1980s because they were too successful. And the next country that might lose that status because they might be too successful could be Brazil. Or countries have lost GSP because they've become members, for example, of the European Union. There were certain countries that once they became a part of the Union, they lost their own separate status. But I would imagine that the Philippines and Thailand and others are still eligible for GSP.
Thank you.
I'd double check. It's something that you can find. There's a list that's kept current in the harmonized tariff schedule of the beneficiary developing countries.
Okay.
All right, and the next slide talks about still another exemption opportunity, and that's through use of what's referred to as the temporary importation bond program. Outside the United States, for example, in the EU, they refer to this as inward processing relief. And what this allows you to do is to bring goods into the United States, just a bond upon their entry, and not pay duty. You're allowed to alter or repair the goods, And the catch is you've got to re-export 100% within a certain time. Typically, it's 1 year, which can then be extended for further periods for, I think, a total of either 3 or 4 years. You've got to account for wastage, but the TIB program, if you are up in such fashion that you're bringing goods here to the States and then you're looking to do some processing and then re-export them, TIB is a good alternative to the plain vanilla version of paying duty and then looking for a drawback. Another catch is that if you fail to re-export in a timely fashion, if you fail to extinguish the bond, then that will lead to liquidated damages, which are typically double the duties that would have been paid. So those are some of the duty elimination opportunities. Duty reduction is another way to go. If you've got to pay some duty, you might as well see if you can lower the amount that you are in fact paying. And
Mark, before we move on, we got another question that came in, which is when will the GSP be renewed, and will it be retroactive in your opinion?
It's been retroactive every time it's been renewed. I'm not sure exactly when it would be, but in my opinion, it would be made retroactive. GSP, and see, we're looking at why a country might be looking for a free trade agreement as opposed to staying in a beneficiary developing country status. On the one hand, you might say, well, both goods would be, if they meet the origin tests, would be entitled to duty-free treatment. The difference is that GSP is something that's for a stated period of time. We've had the GSP program since 1975, and it's expired and has had to have been renewed maybe half a dozen times in that time frame. With a foreign trade agreement, it stays in place and it's forever. So that's the advantage of an FTA as opposed to GSP, and the advantage too of when you're looking at sourcing. If you had an opportunity to go to a country and bring in product that's GSP eligible, bearing in mind that the FTA is permanent and GSP might go away, that may tilt the decision in favor of sourcing from the country that is eligible, that has the FTA status.
At this point, jump in with our first CPE verification question. We've just reviewed several approaches or strategies to eliminating dues altogether. So the CPE question number 1 is eliminate.
Okay. The next question, or the next point that we're looking at is duty reduction, and the mirror, if you will, of TIB, or the inward processing relief, is outward processing relief. The ability to send goods offshore, to a foreign country, to do processing there, and then to bring them back. The Generalized tariff schedule allows you to have essentially duty-free entry on those goods. You're only paying duty on the foreign value. You're not paying duty on the value of the U.S. components. An example would be windshields or catalytic converters that are being sent for assembly into a foreign car, a Volvo or a Japanese vehicle, for example. Assembly abroad, taking U.S. components and assembling them, is the perhaps the most widely used of these U.S. goods returned provisions. And that program has given rise to a lot of and not of promulgation of rulings and regulations on what's meant by permitted assembly and what is allowable in terms of an incidental operation. You're not able to advance the value of the foreign components except by actions that are regarded as incidental operations. There are also separate provisions for the sending offshore of goods for repairs or sending goods overseas on a temporary lease basis. There are a number of these outward processing relief programs that are set forth in Chapter 98 of the Harmonized Tariff Schedule. And in fact, the outward processing relief and the assembly abroad is really what drove what we referred to as the Maquila or Moderator program in Mexico prior to the coming into force of the NAFTA in 1993. There was a lot of activity with U.S. goods being sent to Mexico, and they're really going there to take advantage of this very program, this assembly abroad. That's what drove the maquila industry in Mexico. Another example of duty reduction gets us into tariff engineering and also into valuation planning. The major elements in terms of assigning the duty rate to a particular imported product are the tariff classification, what is a particular product, and the PS or Harmonized Tariff Schedule category or item number that applies will dictate what duty rate that you should be looking at. Most duties are assessed on an ad valorem basis, and you're also looking at the declared value of the goods. So it's important to focus in value, 5% or 10% of what? Well, valuation laws tells us how to define the what, what the tax basis is. And the third element, and we've already kind of touched on this, is the origin of the product. So those are the three moving parts, if you will, that we're dealing with when we're looking at planning, and we're also looking at tendering the appropriate duties. The first here talks about tariff engineering, and that is a reference to the notion of actually designing the product with the HTS and the duty rate in mind. The example that's often given is Air Jordan, and for that is that the duty rate imported athletic footwear will vary greatly depending on the outer surface of the shoe. So if it's leather versus cloth versus plastic. And the sport shoe industry is very, very aware of this, and their products and other product sectors as well are similarly aware. They actually design their products with the tariff schedule in mind. Sets is another example. If you bring in 5 different pieces and assemble them into a retail set after importation, you're paying duty on the separate status of each of those 5 pieces. You might be able to take advantage of the provision for retail sets, and you import the retail set, and duty rate for all of the pieces will be derived from the duty rate that attaches to that piece, which gives the essential character to the retail set. So smart retail folks are aware in the consumer product category. They're aware of this, and they will, determine whether or not it makes sense to do the assembly into a retail set. Here, it might be more costly to do so, but they'll save duty if they do it overseas. So that's something that they will take into account. Valuation planning, as I noted, if we're looking at the dutiable value give rise to the duty, then smart companies will say, well, let's take a look at dutiable value, and we will take out of the dutiable value certain non-dutiable charges. There are certain elements that are never dutiable, installation costs, for example, and another example could be international freight. If you're going to be importing goods and you're going to be paying in a one price, a bundled up price that includes installation or erection of the unit, then you're paying duty needlessly. What you want to be able to do is to separately account for or allocate the amount or an amount for the installation or erection, and therefore you'd only be paying duty on the underlying value of the product and not the installation cost. So unbundling is a very basic valuation planning technique that you should be taking a look at. An example is depending on whether or not you're in an industry where you are sourcing overseas, you're using a middleman to help you in your sourcing. A lot of companies will have a sourcing company in Hong Kong, for example, if they're looking to source from Asia. With the use of a middleman sourcing strategy, then they can save duty if it's done properly, in the sense that if they're paying a buying agency commission to the middleman, and if it's done truly separately and not embedded into a single price, then the compensation in the form of the commission is non-dutiable. It would be, for example, to pay the middleman and then ask the middleman to remit the funds to the factory. That will result in a higher duty being paid, because the amount being paid to the buying agent in that regard would be seen to be dutiable. First sale for export refers to a valuation technique where the middleman is buying and reselling. Think of the middleman as a trading company, for example, or think of a vendor that does not have a manufacturing capability of its own. They look to source to various factories. If you have first sale for export and you meet the threefold test that you need to meet for first sale, then the duty is paid on the price that's being paid by the middleman to the factory, rather than the middleman's invoice price to you. And in that sense, you're taking the middleman's markup out of the dutiable value bucket. For example, would be interest on trade payables. That is another unbundling reference. Interest on trade payables can be non-dutiable. If you're paying on net 120 or 180 terms, part of that price could be referred to as interest, and assuming there's no withholding, perhaps you're dealing in a context where the bilateral treaty puts either zero or a lesser withholding rate than the duty rate. You could be ahead of the game in terms of lowering the dutiable value. Duty reduction, we could also be looking at lower user fees. We talked earlier about foreign trade zones, and Justin pointed out that in addition to the customs benefits, there's the additional benefit of the ad valorem property tax on inventory. Another example that many companies will take advantage of is that using a trade zone allows them to make a weekly entry. Because you're making a weekly entry, you could conceivably be shrinking the number of entries to 52, and you are shrinking the merchandise processing fees because the MPFs are assessed on a per entry basis. So if fewer entries, there are lower, or there are fewer MPF payments you're making. Finally, manufacturing in a foreign trade zone gives rise to the inverse tariff principle. You're to actually step down or lower the duty rate to that status which applies to the foreign part, for example. You are able to take full advantage of that, but of course that presupposes that you're aware of what the competing duty rates might be. The classic example used to be you bring in a car radio, which was dutiable, I think, at 6 or 7%, and installing that into a car with a duty rate of 2.5%. And by doing that within a foreign trade zone, you'd be lowering the duty rate from the 6 or 7% down to the 2.5%.
One comment on the user fee area, Mark. I think the same concept applies in an outbound setting. We've had some clients looking more and more at doing business in Brazil. I think at first blush, some of their duty rates may approach 100% for quantities of goods, very similar to what you described. And Brazil has a per item charge and frankly a number of different per item charges. So that for shipping one item of low value, the duty rate can be or to be extremely high, again in the neighborhood of 100% in the case of a client. Dollar volume and number of units shipped into the country increases, the duty rate will fall to still in the case of Brazil, but certainly a more modest level.
Okay, yeah. Well, foreign trade zones, they're local, what they call free trade zones, or export processing zones throughout the world. We actually have an FTZ program since 1933 or 34, and we were, basically following a European model. The whole idea of the FTZ program was to be a more efficient and export enhancing, to have a more efficient program than the duty drawback program that was in place.
Before we move on to a couple of duty deferral and refund opportunities, I want to chime in with our second CPE verification question. We just have several approaches or strategies to reduce the amount of duty paid. So the answer to CPE verification question number 2 is reduce.
Okay. Now we're going to talk about deferring duties and refund opportunities. Basically, the deferral of duty, we're looking at a cash flow pay. We've seen where goods in a foreign trade zone or customs bonded warehouse are not yet in the customs territory, and so the duty can be deferred until they're actually withdrawn. So a lot of companies, if they're looking to store inventory for appreciable periods of time, will look at putting the FTZ or customs bonded warehouse into use for that purpose. So that's a savings opportunity that presents itself. In terms of refund opportunities, the United States has had a customs import program, assessing customs duties, which means since 1789. In the very first Tariff Act of 1789, we also had a duty drawback program that was for a refund on re-exported goods of up to, or not up to, but of 99% of the duties paid. It's somewhat complicated. You've got to be able to demonstrate to customs satisfaction that In fact, you're entitled to the duty refund. You have to prove that the goods were initially imported, that it was initially paid, and that the goods that are exported tie in with those duties, either same goods or goods made from imported parts or through some sort of a fungibility or accounting program. And there are also limits under NAFTA for manufacturing. So it's something you may want to consider. There are certain circumstances where you can't take advantage of any of the other programs, and the duty drawback program is still the best way to go. So something that you should be mindful of, and it would be remiss if we didn't mention it. Finally, if you have made entry and you feel that you either pay much or you were made to pay too much because customs insisted on entry under a certain tariff category, for example, you can file for a refund by means of a protest or post-entry letter. Those are filed with the local port. There's a strict time limit. In the case of protests, for example, it's got to be filed within 108 days after liquidation. The post-entry letter would be filed entry but before liquidation. So it depends administratively of where you are. You would file, the one or the other submission.
Point of clarification on the deferral point for foreign trade zones, and correct me if I'm wrong here, Mark, but when we're talking about importing goods into the United States and subsequently exporting them, we're talking about a permanent reduction opportunity in the case of foreign trade zone. The reason here again showing up is because we're talking about importing goods in the United States and then ultimate delivery within the United States. So the former example I mentioned is a permanent elimination strategy where if ultimately shipping goods to somewhere in the United States, we're really only looking at deferring that cost using a foreign trade zone, correct?
That's exactly right. And of course, a variation, you transfer goods from one foreign trade zone to another. For example, a lot of the auto companies have insisted that their first-tier auto suppliers have foreign trade zones of their own. They want the supplier to stage goods here in the United States in the foreign trade zone, but preserve the unpaid, the declared status, and you can transfer from one to the other. But when the goods are ultimately entered into the customs territory, it's at that point that we're looking at the deferral of the duty, putting it until that time. And as you just pointed out, for goods that are re-exported directly from the FTZ or customs bonded warehouse, they never enter the customs territory here in the States, and so therefore we never see any payment of duty on those products.
I want to comment on duty drawback. We've had a few clients that have looked at this over the years, and it seems that most feel that is such a cumbersome process that the dollars need to be pretty significant in order to go through that process, keep track of the compliance, and so forth. Can you maybe expand on that a little bit, Mark?
Well, yeah, it is a very complicated process, very cumbersome and very lengthy. And in fact, as I pointed out, the reason why we have a foreign trade zone program is 80 years ago, Congress said the duty drawback program really isn't working all that well. 80 years on, it's still a problem. You can hire consultants with who have broker status to do that for you and manage that. There are also some software programs in place that will help you in the process. Depending on the volumes, you could be you'd be looking at a professional fee, if you will. Oftentimes, it's a percentage of the recovery. In the one, it's found money, if you haven't taken advantage of it before. But you could be looking at paying, depending on volumes, of course, anywhere between 5 or 10% on up to 30%. Or you could be paying somebody, on an hourly basis if you choose to go to an outside consultant to help you. But you've got to be able to have a complete audit trail, tying everything in from the point of entry up through the point of export. And if goods are changing hands, you're making use of certificates of delivery and everything else. It can be very, very complicated.
With that, I'm going to move on to a discussion about some tax considerations that are very much related to customs duties. And with that, I will turn it over to Mukesh Patel.
Thanks, Justin. Mark, thanks. In this section, what we want to do in the final section here is really kind of switch gears and review the interplay between transfer pricing and customs. On this slide, I will go through transfer pricing and customs, respective importance issues that arise when there is interplay between the two, as well as discuss the U.S. tax reporting requirement. On the next slide, Mark will discuss technical interplay, provide an overview of the convergence between the two practices. There is tie-in, so naturally you would expect that there would be convergence of the two important practices, and what can do to minimize the negative impact from managing what appears to be a goal. And as I go through the slide, you'll understand what I mean about the contradictions between transfer pricing and customs and tensions that potentially arise when you're dealing with these issues. So first, let's begin by understanding what is transfer pricing, its purpose, which I think will provide context for those of you that may be more kind of background with customs and not familiar with transfer pricing, just to provide you with some context. Transfer pricing at a very high level is a set of rules designed to ensure transactions that occur between related or controlled parties are transacted or priced as closely as possible as conducted with a third party. So in principle, what you're looking at is that when you get transfer price is that it's matched. The seller would charge an independent arm's length customer, or buyer would pay an independent arm's length supplier. So talk about the first point here, transfer pricing and arm's length. That's what's commonly referred to as the arm's length standard. So why do we really care about transfer pricing? In the absence of transfer pricing rules, multinational entities do not concern themselves, with equitable apportionment of profits that arise from related party transactions spread out amongst multiple jurisdictions. While an unrealistic transfer price may not affect the overall enterprise directly, they do become a concern when misused to lower profits in a particular jurisdiction with, let's say, high taxes, or profit in a country or jurisdiction which is low or is tax haven. The inherent assumption here is that multinational entities could manipulate transfer price to minimize the amount of tax paid on profits when transactions in question are with related parties. What governments have done is implemented transfer pricing regulation, a major tool for corporate tax avoidance. This results in transfer pricing rules for goods, intangibles, and services that essentially require you to deal with pricing between related parties at arm's length. And it becomes a concern when you have these rules. It's a concern of the taxpayer, it's a concern of the national tax authorities as well as the customs authorities who are responsible for overseeing these cross-border flows. So transfer pricing important. We're aware that over the last decade or so, globalization has really increased. It has led to international transactions between related parties. By one measure, 60% of trade is conducted by multinational entities. and a significant amount of this trade is between related parties. So globalization provides opportunities for economic development and growth through cross-border trade. At the same time, we're seeing an uptick in terms of the developing countries as well as the developed economies put in place transfer pricing regulations. So developing countries have to implement transfer pricing. They were not in existence in the past. Nations have really started to be more aggressive, tighten up the transfer pricing rules. So really what we're seeing here is really a fight for that profit. The silver of that profit, every jurisdiction wants to make sure they get a fair cut. Moving on to the importance of customs. Again, I think the driver in this situation is transfer pricing. We appreciate the importance of transfer pricing, but over the last decade, we've also come to notice that customs as a function has also become an important item as far as cost is concerned with respect to multinational entities, as well as governmental authorities. I think are beginning to realize that customs is another area where they can focus when there is not an issue with respect to revenue. So transfer pricing as a starting point influences both direct and indirect taxes that the governments collect. So cross-border transaction is usually the starting point for a customs duty and for determining profit arising to each party involved. And for the allocation of tax bases amongst countries. From a tax perspective, transfer pricing determines the amount of income that each party earns and the amount of income tax that is due both the country of export and the country of import. In this situation, a higher transfer price may reduce taxable income in the country of importation and increase the taxable income in the country of export. So a low transfer price obviously has the opposite effect. Now, customs perspective, however, the price has a direct impact on the determination of customs value. So what do I mean? The lower transfer price, the lower the customs value and the applicable customs duties. So see the tension that I talked about earlier with respect to transfer pricing values and customs values, which can sometimes lead to frustration for taxpayers as the two agencies are at odds goals with respect to the collection of the same kind of revenue with respect to the government. You've got two separate entities that are at odds with each other. So when dealing with transfer pricing and customs, what are some of the issues that we come across? One of the items that I think most of the multinationals will point out is that it's becoming really challenging to concurrently manage both transfer pricing as well as the customs risk. And primary reasons, I think, is really to do with the fact that you've got two separate rules that are being administered by bodies, one that's responsible for collecting the direct tax to transfer pricing. The other one is the customs duty, an indirect tax, but nevertheless a cost to a business. And what this does is that it kind of fully complicates cross-border trade. It becomes costly. And it really appears to be contrary to the objectives not only of the multinational but of national governments, in the sense that they would want to see a free flow of trade that occurs. And I think this is one of those things that you see kind of as a roadblock or a challenge that a lot of companies face. In the U.S., the Customs and Border Protection is responsible for customs, internal revenue for transfer pricing. So essentially, just to kind of reiterate, they're both with collection of revenue, making sure that with respect to related party transactions, that they're not unduly influencing those transfer prices. But they seem to have kind of opposing objectives as far as the collection is concerned. So if one entity wants to collect more tax, it kind of diametrically opposes the impact it would have on the other entity. And one of the things you see is that, they essentially operate under different rules, which create a lot of complications. But because transacting and customs are governed by different rules and enforced by different authorities, you can get a situation where a taxpayer can transfer pricing adjustment that will incur additional customs duties on the same set of impositions. And this is the classic situation of double taxation. And this, again, kind of leads to some of the frustrations that arise from what appears to be the contradictory positions taken by tax and customs authority. I think the side effects of this is really, you see how the tax departments, tax directors focusing their attention on that they're in transfer pricing compliance, don't understand or erroneously assume that meeting the arm's length standard for tax purposes also demonstrates compliance for customs purposes. And this can be out of ignorance. I think Justin spoke about earlier. Not understanding the rules or not understanding the impact that the customs can have on cross-border trade, particularly with respect to related party transaction. The fact is, Customs and Border Protection issued official positions confirming that transfer pricing in and of itself isn't going to be sufficient to satisfy customs requirements. What we do is, I think, with careful planning and thought, a transfer pricing study can form part of an overall solution for customs purposes. There are differences between customs and tax regulations. You're able to kind of achieve a certain amount of reconciliation. I think what you do is up front, you really kind of plan for both transfer pricing as well as customs on the front end, as opposed to treating customs as an afterthought or not being part of that overall strategic planning that occurs with respect to customs. And I think overall, if you have both of them, I think what you deal with them collectively, this reduces the likelihood of getting whipsawed between tax and customs authorities. Finally, with moving on to the tax reporting aspect, it's a slide, but with respect to related party transactions, there is a reporting requirement where you have transactions that occur between a foreign parent and a U.S. parent on a 5471. It's in Schedule M. So that's where you have the related party transactions, where you have an inbound related party transaction occurring. But interesting, and I think what's on the slide here is a 5472, which is where you have a foreign parent deal with the subsidiary. Not only you have the related party reporting under Part 4, but interestingly, if you look at Part 5 of 5471, also a question on there on line item 2 that deals with the valuation of the purchase. And what that is alluding to, and I think Mark will go into this a little further, is the limitation that's placed on inventory valuation under 959 Cap A. And that eventually kind of dictates as a general rule that your customs value your value for inventory purposes as a general rule. So to summarize, I think at the end of the day, that there is definitely a tie-in between transfer pricing and customs. I mean, they're both costs to an organization. I think it would help and if those costs were dealt with on an equal footing, and also as part of an integrated approach as opposed to binary one or the other. So that I will turn it over to Mark to go over the the items related to valuation and the convergence that occurs between transfer pricing and customs that you would naturally expect.
Okay. There is that was an excellent presentation, because we do see that, in fact, there is a great deal of interaction between the two disciplines. Section 59 Cap A basically does a ceiling as the declared customs value for the goods in terms of how they should be carried on the books and inventory for income tax purposes. It's certainly true that there are certain elements that we talked about here are never dutiable, and yet there are elements be accounted for here if we're able to, or if we're trying to come up with an equitable approach. And regulations under Section 1059 Cap A do allow for the upward adjustment to account for freight, insurance, and assembly, all of which can be non-dutiable. Customs first sale rule can pose a problem in the sense that for customs purposes, you're going to be carrying, you're going to be declaring a dutiable value of the first sale price, let's say 85. That's the price paid by the seller, the middleman seller, to the factory. The amount that's being paid by the importer to the seller, though, is 100. And so, you'd like to be able to take advantage of first sale without taking a hit. And there have been a couple of rulings issued by the IRS that allows you to take advantage of first sale and to not get whipsawed by dint of Section 1059 Cap A. The mere point that's been made quite eloquently by Mukesh is that these two disciplines are in the process of convergence. There has been, in the last 6 or 7 years, a great deal of dialogue between the World Customs Organization and the OECD. The OECD sends an observer and actually a participant from Paris to Brussels to the fall and the spring meetings of the WCO's Committee on Valuation. And the topic of the day is what should the convergence of the two disciplines look like? As Mukesh also discussed, if you are looking at the two disciplines, the best way to perceive them is to see them as disciplines that should be dealt with simultaneously and not in a sequential fashion. And the second point to make here is that with astute planning, you might be able to actually craft your APA or transfer price study with the idea in mind of making a later dual use discussions with customs, and turning it to that dual use. As one final point, customs wants to see addition on a very narrow basis regarding same class or kind of merchandise, to the extent that it's possible to craft an APA or study based on that kind of micro or granular analysis, then you're going to be reaping an advantage in the later dialogue with customs.
So, this is Mukesh. Just with respect to the APA, I mean, when a taxpayer reaches out to the IRS, to seek an APA, I mean, does it make sense for them to also kind of involve customs at that point, when you talk about making sure that you have a dual use documentation or methodology?
It certainly does. I've seen rulings where customs has actually been invited to participate, to be given a seat at the table, and that they certainly need to be given access to the submissions, and it is absolutely the best way to proceed. I think ultimately, what I and other observers, would like to see is a formalized dual application, a single document that would serve the purpose not only of securing an APA perhaps, but also getting a binding ruling from Customs headquarters the related party pricing meet the customs valuation criteria to show that the price has not been influenced by the relationship.
I want to quickly run through the summary. I know we've gone over a couple minutes here. In terms of our recommendations overall, we talked early on, I think it's prudent to designate an owner of this cost. Again, we see a lot of gray lines in terms of who's responsible for evaluating this cost, properly managing it, and looking at the opportunities available. So step one is to bring some accountability by selecting somebody in the company to monitor this and evaluate it. Step, determine how much you're paying. Again, we've had a number of conversations with a number of companies over the years. Might be paying 6 or even 7 figures in import duties on an annual basis. Never really summarize that number to figure out how much time and energy is worth spending on trying to drive that number down. Third step, review your facts. We talked about items like first sale for export. To determine whether those types of opportunities are available, you got to understand your suppliers, who your suppliers are, who are your customers, where's product going, how much processing is taking place at each step along the way. Those are the types of facts that you need to have in hand. Next step, look at some of the planning opportunities we discussed today. Maybe you've vetted each and every one and effectively left no stone unturned in terms of driving down this number. And in closing, just review the tax implications. Again, there was a lot of discussion about 5472 reporting and so forth, and I know we have a number of automotive suppliers on the line. Pratter is, when you got all your tax return, to the extent we do take advantage of some of these opportunities, you're marking a box on that tax return that says there's a disconnect between what you pay your related party and what you're declaring for customs value. So you want to make sure that those I's are dotted and T's are crossed. One last piece, we need to ask or convey our final CPE verification answer. We've talked about some of the tax considerations related to customs duties. So the CPE verification question number 3 is tax. At this point, we do not have any questions in the queue. So again, if you could complete the feedback questionnaire as well as the CPE verifications, submit to us. We will ensure that you get CPE for today's session. And that we conclude our discussion. Thank you.